In the second quarter of 2024, the gold market signal diverged from retail sentiment. While private investors sold off 45 tons of gold, a massive, centralized force absorbed a record-shattering 289 tons. Before we reveal who is behind this new market reality, make sure to like and subscribe to stay ahead of the curve. Global central banks drove this demand, resulting in a 62. That trust began to erode when the United States weaponized the dollar through expansive sanctions, effectively freezing sovereign nations out of the international payment rails. Emerging markets suddenly faced the reality that their national reserves, if held in dollars, could be unilaterally deactivated by a foreign power. This pressure forced non-Western nations to develop a financial infrastructure that operates independently of Western political control. The shift was enabled by a subtle regulatory update known as Basel III. This diagram illustrates the historical penalty placed on gold. It was previously classified as a Tier 3 asset, meaning banks were required to apply a 50% risk weighting to their holdings. This made gold highly inefficient to hold compared to sovereign bonds. Under Basel III, that penalty disappears. Physical, unencumbered gold is now reclassified as a Tier 1 asset with a 0% risk weight, legally equal to cash in bank capital calculations. Central banks are moving beyond simple hedging. They are structurally positioning physical gold as the foundational collateral for a new financial system. By mathematically equating gold with cash, international regulators have formally acknowledged bullion's return as a primary form of money. The BRICS bloc is utilizing this massive shift to engineer a new settlement currency known as the unit. This chart shows how the asset is anchored. The unit functions as an internal shock absorber, using gold's stability to dampen the volatility often associated with emerging market currencies during international trade. This collateral requires a digital rail to move on. That rail is Project mBridge, a decentralized ledger designed to facilitate these new settlement assets. mBridge rewires global trade by enabling direct, peer-to-peer payments that bypass Western correspondent banks and the SWIFT messaging network. The project recently reached its minimum viable product stage and integrated Saudi Arabia as a core validating node, marking a massive shift in how energy trade can be settled. Combining a gold-backed asset like the unit with decentralized rails like mBridge creates the infrastructure for an alternative economy that operates outside the reach of G7 financial restrictions. The rollout is already moving from theory to policy. At the 2024 Kazan summit, Russia formally proposed creating a BRICS bridge based directly on this architecture. This triggered a sharp reaction from the West. The Bank for International Settlements abruptly withdrew from the mBridge project to avoid facilitating a system that could bypass international sanctions. Institutional analysts are revising their long-term forecasts. This graph shows a Bank of America projection where gold reaches $5,000 an ounce by 2026, driven by sustained deficits and this new structural demand from central banks. This awareness is filtering down to the public. Recent Gallup polling indicates that Americans now view gold as a superior long-term investment compared to stocks. The global payment system is bifurcating, marking a clear challenge to the era of the US dollar's uncontested global monopoly. This transition is not being announced at a single global conference. There is no modern equivalent to the televised agreements of the past. Instead, the Great Reset is occurring quietly within central bank ledgers and blockchain notes. The global economy is moving away from an architecture built on sovereign debt promises and returning to a system anchored in hard collateral. Will the BRICS unit and physical gold truly redefine global finance, or can the dollar adapt to this new reality? Let us know what you think in the comments and subscribe for more in-depth analysis.